Hey, good afternoon, good evening, everyone. It is April 7th. It's Monday. It's Monday after the market closed. And boy, I can't believe I'm celebrating a 0.099% update on the NASDAQ. But boy, after last week, I'll take an even day. Just take a day off from looking at 3 to 5%, 6% losses on the NASDAQ. It was wicked. We went down on the NASDAQ 10% over 2 days. That was pretty nasty. What looked really interesting to me, and I think productive, is the NASDAQ opened the day down. It was pretty down a fair amount, a couple percentage points, maybe 3, 4%, and it fought back. It really, from the bottom to the top, it rallied back 10% in one day. There's a lot of buyers in the market now. And what I mean is, now that we've gotten to lower prices of stocks, I think some buyers are out there picking off some low priced stocks that represent companies that they really want to be owners in. That's very good. It makes me feel like we're near a bottom, establishing a bottom, and I don't want to get carried away. It was pretty rough last week. For all I know, we're going to go down a little bit more. But it was good to see that the market just kept fighting back, that the market would sell off and then buyers would come in and pick it up. And it happened through the course of the day. It's just one day. It's just one day. But hey, after last week, you know what I mean? Like, we had those rough days. Holy smokes. We went down 13% in a little over 2 days. So that's why I'm celebrating. Hey, look at that, man. We have a green day, just slightly green, but I'll take it. And the futures market looks pretty decent. I mean, it's too early to tell, but futures are pointed up. Hopefully it sticks, and hopefully we have an update tomorrow. But, fingers crossed, but I'm not counting on it. I'll count it tomorrow at 4 p.m. Eastern. Once everything's all said and done, that's when I'll count it. For now, I'm just going to keep my fingers crossed and just look at what happened. So the NASDAQ fought back. The S&P did end the day down 0.23%, not too bad. And it also just kind of fought back and tried to, I think when there was heavy selling, it was met with some buyers, which is good. It would have been another down 3 to 5% if there was heavy selling and no buyers, because nobody would be there to buy it. The stock would just continue to drop. Stocks would continue to drop in price. So that was interesting. Crypto is up a bit. It's in the 70s. Boy, we're at 85 not too long ago. It's up a little bit, but it's got some losses to make up for. And looks like Bitcoin's up, Ethereum is up. Well, that's not bad. That's not bad for a Monday night. So that's what's going on out there. Looks like we've got Herdo. How you doing, man? Very good to see you. Hopefully you had a good day. I'm going to be opening up with some comments. I had a couple companies in mind, and I wanted to take a look at. One of them announced their earnings today, so I'll be going over that. And then any members that want me to review a stock, please put it in the chat. So far, we got Herdo's a member. Hopefully some others make it into the live stream. All right, so that's what happened there. Some stories. I think CNBC does a decent job of putting the stories. We have a couple of influential people beginning to voice their concern around tariffs. Here's a mega donor, Ken Langone, and he's saying that, hey, tariffs could really derail the economy, really hurt companies. So hopefully that's getting up to the top and they're beginning to think about it. The other big story out there that caught my attention, because I'm a CVS stockholder, is that the current administration approved Medicare payments to pharmacies and for prescriptions, and they approved a higher rate than the previous administration. So that was good news. And I know CVS, I'll take a look at the CVS stock a little bit later. It's rallying in after hours. So a couple of headlines out there. One thing, and I don't know if you guys track it, I certainly do, is interest rates. And interest rates really went up today. It's not showing them anymore, but we saw a big climb on the long-term bonds. And that shows that money was leaving bonds. And again, remember how I was saying we had buyers in the market, that when the market was selling off, buyers were there to buy the stocks when they dipped. I think some of that money out of long bonds came into the market and they bought up stocks. That's my theory. We'll see if it plays out like that tomorrow. When we look at the heat map, it is interesting that some stocks did really well, like Nvidia, Broadcom, Meta, Amazon, and some stayed in the red. Apple, Tesla stayed in the red. Home Depot is in the red, and some others. So interesting that some stocks did well, some stocks lagged. It wasn't just whole sectors were moving in one direction or the other. I guess one sector that did move is semiconductors. I guess the news has been so bad that it finally had some upward movement. So there you have it. This sector was flying up for a couple of years, but over the last 4 or 5 months, it really been struggling, losing lots of money for investors. So interesting. CRM Salesforce was up. Good to see that. Uber was up. Great to see that. Adobe was down. Not good to see that. So that's what's going on out there. Heat map showing what stocks really performed today. I usually like to show sectors, but right now the stock analysis site is throwing me off because it has one number that's way off. Financials is not up 31,000%. But just eliminating that sector, only consumer staples is in the green. Everything else is in the red. Some, more red than others. But I guess the pecking order is consumer staples on top, utilities, materials, healthcare, and then real estate. Looking at the big caps, and I created a video today just to look at the Mag 7. And the Mag 7 is not a place to seek refuge during this sell-off. They've been selling off along with the market. Apple's really been struggling, down 27.4% year to date. And that was once a $3.6 trillion market cap company. It's down to 2.7. They're down $800 billion plus in market cap. Those are outflows out of Apple going into bonds, going into other investments, international investments, and so forth. Microsoft's kind of held their position a little bit better. They're at 2.66 billion, and they are down 15%. Nvidia at times has been number one just for short periods, but then it's been number two for a while, and now it's number three. It's really lost a lot of value. Amazon's right there, Google, Meta, and Berkshire entered the picture, number 7. And then Tesla's just really struggled. I know that Tesla has lost from its peak. It's lost 50% of that stock value. Incredible. So this week, it's starting better than we had last week. We got to stabilize. We got to kind of let this market stabilize under these lower prices. We are seeing nicely discounted prices out there, which is good. It's just now, who's going to have the courage to buy? I bought a nice list of stocks today. I shared them on my Discord, and I'm buying into these companies that I want to be an owner in. And I'm going to buy them. If they're down tomorrow, I'm going to buy them again. And I'm going to keep buying until I run out of dry powder. And I'm already figuring out how I'm going to create another pile of cash to put into the market. If it keeps selling off, I'm going to keep buying. So we are starting earnings season. We started with a couple small names and a small cap company, but I think everybody knows Levi's, right? Everybody owns a pair of Levi's. That company's been around for more than 100 years. Started during the gold rush. Legendary brand. Let's take a look at this stock. We're going to look at it and we're going to do a deep dive. I did a little homework before the live stream, so I'm ready to go. It's a small cap, 5.5 billion. And they announced their earnings and the stock is flourishing, up 8.62%. This is a consumer discretionary stock in the apparel business. This is one of the industries that these tariffs are really going to hurt. So if we look at this company and look at the tariffs, This is an interesting stock to look at, to see what kind of comments they provided on their earnings release. So let's take a look. So market cap 5.3 billion, revenue is 6.36 billion dollars, and what you're getting the stock for less than one time sales. And Herdo, thanks so much for the super chat, man. You are awesome. That's the second one that you've given me, I think in the last week. So I appreciate it very much. Let me know which stocks you want me to look at. So we got Levi 1-to-1 on cost of sales, forward PE 10.87. That's a nice low PE, but this is a consumer discretionary stock. It's a slow grower, as I'm going to show. It has a dividend. Now, I have a lot of investing friends that like dividend stocks, so I don't like to badmouth them too much, but I would say that I don't focus on the dividend rate, because sometimes these companies put up a nice dividend rate, but it's not a really good company. It's not a really good business, but they advertise this dividend rate. So let me take a close look at Levi and see if I think it's discounted. Some analysts think this is really discounted. Over the past year, Levi is down 34.3%. Wow. And over the year to date, it's down 22%. So it has some upward, I think, room to go, because it's down so much. It really came out of COVID. Look at that. It just went on a win streak. It went from like $12 a share to 28. Incredible. And when you see this stock over the 5 year, it's only up 23%. So interesting. So this hasn't been a consistent, upward trending stock. Like if you look at a Walmart, or I'm trying to think of a company that is in kind of consumer products, or Costco, those have just kind of guided up and to the right, which is what we want to see as an investor. Now, looking at earnings and looking at growth, for the last 2 years, they've been a slow grower. They had pretty decent growth in the earnings. I did read through the earnings, and I'm going to show them to you in a second. The fourth quarter did have good organic growth, which looks good, but it is single digit low growth. So it's not a high growth company. And we're not dealing with an overly profitable company. We have gross profit of 60%, which is very good, by the way. For an apparel company to be doing 60% gross margins, that's phenomenal. So very good on that line. When we look at free cash flow, it hasn't been really consistent. So what I'm going to do is I'm going to take the last 4 years, add them together, and divide by 4 to get a 4-year average. That's what I'm going to use for my evaluation that I'm going to show you in a bit. That way, I'm not being overly optimistic taking 670, which is the high watermark over the last 4 years. If they had showed that they are consistently growing year after year, or showed a little more consistency, I would probably go with the latest year. But you see how this is all over the place. 2021, it was at 570, and then it went negative 39, positive 121, and then 670 for the trailing 12 months. So that's what I'll use there. So this is a good business. It's just not growing really, really well. When we look at their balance sheet's decent, but they do have a little bit of debt. We have $690 million of cash, and then $2.21 billion of debt. So they have about $1.5 billion in net debt. That's a decent balance sheet. I'm not too afraid of that, but they do have debt, and they don't have a ton of revenue and EBITDA to pay it off with. Analysts really like Levi's, and a total of 11 analysts cover the stock, and they think it's 53% discounted. There's an analyst that's very optimistic at $25 a share. And then the most pessimistic analyst is at 14, which isn't too bad because the stock was trading at $13.50 today. So not bad. I would call it, this is somewhat of a safe stock because the brand, right? Levi's is going to keep selling. You got kids going back to school. They're probably going to wear Levi's. I wear Levi's. I like the Levi brand. I think a lot of people like Levi's as a brand. It's just a tough business. Apparel is tough. And these guys are having their product manufactured in places where we now have tariffs. The tariffs go away, I think these guys will do a little better. All right, so we looked at the company just high level. Now let me look at the valuation. Actually, let's go into their earnings. I wanted to point a few things out, then I'm going to show you the valuation. So the company did have a good quarter. They grew 3% on net revenues, and then organic revenue up 9%. Okay. Um, I wanted to highlight that they did their earnings announcement against the tariffs. The tariffs are so new, and I'm not quite sure how long these tariffs are going to be around for. So I'm highlighting where the word tariff is showing up on their earnings. And they're saying company maintains full year outlook, excluding the impact of tariffs, because tariffs could go away in a week. They can go away in a month. They can go away in a year. Obviously, if they're around for a year, it's going to impact Levi. Now, they put it in a couple of different places. They probably did the right thing. They're kind of saying, hey, we're operating the company Levi Strauss, and we're going to operate the business as best we can. We're not in control of tariffs, but they will impact our business. Right now, we're giving you numbers excluding tariff effects because, again, we don't know if they're going to be around a week, a month, a year, and we don't know what the impact is, but they are telling us that it could impact their business. So they put it in the beginning of their earnings. They put it in kind of like the paragraph where the CEO is kind of summarizing what the year is going to look like going forward. So tariffs could impact the Levi business. No doubt about it. These guys manufacture their product in places where tariffs are being charged now. So that could be a problem. And they go into it on several occasions. Now, again, if tariffs go away, tariffs go away 2 weeks from now, right? It was a big short story. we had tariffs for a little while. It scared the heck out of everybody, and now they're gone. Okay. And I don't think it's going to have much of an impact on Levi's as well as other companies. But if we're in it for, let's say, 6 months of tariffs, it's really going to affect these companies. And we're going to see prices for these products go up. It's going to force consumers to pay more for certain products, maybe paying more for their Levi's. So I'm hoping that the tariffs are resolved quickly. So that way, these good businesses that employ a lot of people, produce products that we really want, just can be left to just operate as they would like. And that in that situation, having a tariff-free environment, everybody wins. The employees win. They continue to work at Levi's. Levi's continues to produce product for their customers. And that's what I would like. But we'll see how quickly these tariffs are resolved. Now, I took the data from their balance sheet and their statement of cash flows on the trailing 12 months level, and I'm ready to show you the valuation on this company. So all in, once I averaged, the 4-year average for free cash flows, growing those cash flows by just 4%. This is a slow growing company, and then long-term growing it by 3%. This is a little riskier of a company. I'm putting a discount rate of 8.5%. Like Tesla down here is at 8%. Google, Meta is probably 7.5%, 8%. This is a little more risky. Why? Tariffs. If tariffs really hurt these guys, they're not going to make as much money. Maybe they struggle for a while. So having said that, I'm going to use a 4-year average discount by a higher discount rate of 8.5 to get to the intrinsic value of those cash flows. And the cash flows are $5.84 billion of value represented in this field. I add cash and take away debt to get to an equity value. That's the value of the business after we added cash, took away debt, and got the net present value of those cash flows. So we're pretty close to a fairly valued stock. The stock is selling at intrinsic value. If I take all these numbers and do that, it's interesting how close I got to the stock price using that type of logic. On the earnings per share, I took the earnings per share that is expected for the current year, the fiscal year that we're in for the company. These companies, they don't get very high PEs. So I went with a 10. and it gets to about a 2% discount. So overall, it's a fairly priced stock. Now, a company like Levi's, right? Again, they advertise that dividend, and I just don't like stocks that are just okay, but they have a dividend. I mean, I don't care that they pay a dividend. I know how to work around stocks and selling stocks so I can create some income if I needed it. I don't need a dividend. It's also tax inefficient to have dividends versus taking capital gains. So, where I'm going to is, as you have seen on my other videos and live streams, I like to sort out which businesses are really desirable and belong in the green here, which are companies with really strong moats, very profitable, generate a lot of cash. These are really desirable businesses. These are the Google Alphabets, the Metas, the Amazons. And then businesses in the gray are okay. They're good businesses, but they're not great. Then businesses in the red are not good businesses. Almost under any condition, I just don't buy in the red unless it's just obviously such a discounted stock. They're being priced to basically go bankrupt, and I don't believe in it. They're going to go bankrupt, but rarely do I invest in the red. Levi's, where do I put them? I would say that I put them up here. I like their moat. I think their moat's good. The Levi brand recognized around the world. It's been around for 100 years. It's going to be around for another 100 years. So I like that. But it's low growth, low profitability, low free cash flow. You see how on the vertical axis is the strength of your moat, and then on the horizontal axis is how profitable are you? Can you generate a lot of cash? Can you generate a lot of gross profit? And the answer is no. They're an apparel company, low cash flow, compared to other industries. So it's a good business in the gray. Why would I buy a company in the gray? I would buy because there's a really good discount available. And I can show you lots of companies in the gray where I'm getting discounts of 50, 75% based on comparing the intrinsic value versus their current stock price. So Levi's is a stock that I would not buy. And would I hold it? Maybe, if I've held it for a long time. But you saw that the stock had sold off. The stock price is down 34% over the 1 year. So it's not a stock that's been doing great. It's actually been going down and is now matching its intrinsic value that I calculated. So Levi's, again, storied brand, great brand, but it only fits in the gray. In order for me to be an investor, I have to be lured in by a terrific discount. I have to believe in the business. I do believe in the Levi business, but I'm just not getting that discount. So that's the full analysis of Levi's from soup to nuts. It's good to see that we're getting, here's another item to be optimistic about. I opened up earlier showing that the NASDAQ had kind of rallied back when it had sold off. And I'm viewing that as, a small item of optimism, like, hey, great, maybe we're reached a bottom. Another little item of a positive here is Levi's is out with their earnings and the stock is up. That's good. I'll take it. The other stock that's up in after hours is CVS. And before I hit CVS, let me check out the comments, say hello to everybody. Herdo, thanks so much for the super chat. Let me know if you want me to look at a stock. Magical Self, thanks for joining. Liam Bell, good to see you. Jay Zev, I am doing well. Hope you're doing great. Sergio, good to see you, buddy. And then Sabir, number 2, how are you? Carlos, good to see you. And then Ross, great to see you. Really appreciate you guys joining. We are 21 strong on the live stream. Let me show you CVS. So the news in after hours was that the federal government is going to reimburse for Medicare at a higher rate than expected. So when these guys have a person that is eligible for Medicare, they go to the doctor, get a prescription, whoever fills that prescription is going to be reimbursed at a higher rate. So that's causing a nice rally for CVS. And CVS has been getting it done in 2025. Look at that, 42% increase in stock price in 2025. You add that 6.5, we're nearing 50%. Beautiful. Good stuff on the CVS side. And CVS is a discounted stock in my book, and I've been accumulating shares. And I see, Herdo, you've got a stock up there. I'm going to hit JD next. Give me a few minutes and I will get there. So CVS is discounted. It's discounted by 34% because it's been increasing its stock price, but it does really well from a free cash flow perspective. I'm even hitting it with a higher discount rate since this industry has had a few problems, a few issues, and it does have a little bit of debt on its balance sheet. So I am looking at, it looks like Mike, the dividend investor guy, is in. I got to put this comment up. Well, Tomas, good to see you. I clicked on the wrong one. Sorry. Good to see you, Tomas. Mike, the dividend investor guy. I'm mad. CVS was almost down to where I could pick it up since you sold. Now it jumped back up. Yeah, these, well, I'm glad that it jumped up. It's good to see a couple of stocks go up. And it'd be nice to see if we can have an up week or if at least just stabilize. I mean, I'm not going to get greedy here. We got our, what's handed to us last week, and I took my lumps along with everybody else. But CBS, I just saw that the business was kind of getting back on its feet, and I'm discounting the free cash flows at 9%. We have declining interest rates. So keep in mind, if I change that to 8.5, the discount even improves better, which might be the case. It might be more applicable, but this is just a really good valuation. And I'm really liking what I'm seeing out of CVS. I think they're going to continue to work for the rest of 2025. I've been buying into CVS pretty much every week, especially if I see CVS sold off and the price is lower on the day. I buy more shares. I'm glad I was doing that. We've accumulated a pretty good number of shares. I'm glad that it's working. So let me hit JD, which was a request by a member. Let me note that. And then Tomas, you want to look at PAGS. Is that PAGS Seguro? PAGS. Good to see you, Tomas. Good to see you, Mike. And hopefully, Mike, you can get back into CVS. All right. So JD is a Chinese stock. Let's take a look at it. So I can close this guy out and we are on to JD. So JD.com operates a supply chain based technology and service provider in the People's Republic of China. The company offers computers, communication, and consumer electronics products, as well as home appliances and general merchandise products comprising food, beverage, fresh produce, baby and maternity products, furniture, and household goods. Okay, cool. It's an e-commerce company that provides a nice platform. Over the year to date, this thing is back to even, just slightly in the green. Now, Chinese stocks really took a hit because the trade war, it's becoming a little bit of contentious between China and the U.S. Of course, the U.S. Started the big argument with announcing these tariffs. China came back and had retaliatory tariffs. So now it's kind of escalated to a louder argument, I'm going to call it. And Chinese stocks really struggled today. JD was down, Alibaba was down, among others. Maybe an opportunity because I'm going to go over JD and then I'm going to go over Baba, and I'm going to come back to that point, which is why am I still bullish, optimistic about Chinese stocks? Let's hold that, and I'm going to come back and answer that question. So these guys are a $50 billion market cap company, but their revenue is almost triple that, actually more than triple that. Very low PE at 7.39. Looks good. Strong buy according to analysts. Looking at their revenue, this is in the Chinese currency, right? This is US. Yeah. And this is 0.14 would be equivalent to $1 US. Having said that, these guys are roughly at about 160 billion in revenue if we measured it in US dollars. And they're growing at 6.84. That's not bad. And the latest quarter has really good growth. So that looks good. Now, on the growth, this is why I think Chinese e-commerce companies especially are going to continue to do well is JD is not depending on US, residents or residents in Canada. At least I'm not aware of anybody buying off JD and JD, getting most of its revenue from outside the China and immediate region around China. So these guys are going to continue to do well within their region. So they don't need like international trade. The tariffs, I don't know if that's going to affect JD a whole lot because the electronics are made in China. A lot of the products they distribute are made there. So I think it's kind of overplayed. The sell-off is overplayed in my opinion. So that's the revenue growth. And when we look at their free cash flow, they don't show the most current year, but I'm pretty sure I have a valuation. I'm going to take a peek. If not, we'll create one. So this one here, if I took 2023, again, it's 0.14 would be the conversion from the Chinese currency to the US dollar. And that would get me to roughly 6.5 to $7 billion of free cash flow. That's really good because the market cap was only 50. It's a growing business. So this thing's really discounted if I look at cash flows. Gross margins are low because it's e-commerce. They're making a little bit of money, but they sell a lot of volume. All right, so that looks good. Now let me take a peek and see if I have a valuation for JD. I do. So JD, and just so that Herdo, you're a member, so you would go on the member folder, you'd click this guy, and I'm going to update this probably today, and you'd open this file, and you're going to be basically looking at this sheet. So you could always refer to it. So if you're looking at a stock and you want to know what I, analyzed, you can look it up. And if I analyzed it, you'd be able to get to this data on your own. But we're on a live stream, so here we are. So this stock, in my opinion, and based on free cash flows, is discounted by 98%. So I don't think anybody believes that China stocks are not discounted. I think they're nicely discounted. It's a matter of like, what's the appetite for investors to invest in China? And I think the situation's really improved. And a good reason is because US stocks are so expensive. You can find less expensive stocks in China to invest in. I think JD is going to continue to grow and accumulate and compound their growth rate on the top line revenue. They're going to continue to accumulate cash on that balance sheet because, again, they don't have to sell into the US. So these tariffs are not going to be a big barrier to them. They could just keep selling within China and surrounding countries like Vietnam and Korea and Japan and so forth. And in some cases, they even sell in Latin America and other places of the world. So they could basically grow where tariffs are not going to impact them. So overall, I am bullish on Chinese stocks. JD is a good one. I own some JD through an ETF that I own. I don't own it directly because I own Alibaba. I don't want to accumulate too many stocks that are Chinese stocks. The earnings per share gets us to almost the share price, but it is showing that it's priced at a small premium when we look at earnings per share. But I depend on this number more. It's 2/3 of the combined valuation when I blend it. And overall, I think this stock is 61% discounted. As long-term investors, and in my approach, my strategy is to find good businesses and get a very good discount. Buy them below intrinsic value. Pat Dorsey would say, finding good businesses that you believe have very strong barriers of entry and have a discount when you compare to intrinsic value is a way of being successful in investing. Howard Marks would say that it's not as important to pick the best stocks, but it's to get the best price, to look for situations where you would get a great price. So combining those two great investors, this stock is something I could work with. I could buy it at a terrific price. It's a good business. It's growing its top line. You could see that it's meaningful to the customers that keep buying their product. More customers are coming to them and becoming customers and so forth. So JD is a good stock. It would be a buy in my book. And I'll show you Alibaba while we're in the topic of Chinese stocks. Alibaba is nicely discounted. So these stocks in China, right? They're just doing really well. They had struggles a couple of years ago because China dealt with COVID in a more restrictive way. They would just shut down companies and industries until the virus kind of was no longer existing. And that was really hard on these businesses. But now that we're over COVID, that's no longer the case. So Alibaba and JD are doing well. They're both buys in my book and look really good. So thanks for asking about that. Hopefully you thought those comments were interesting. All right, moving on. We're going to look at a couple more. It looks like Tomas, you want to look at PAGS. Got that noted. And then Mike, you want to look at, we just talked about Baba. And Futu. Futu has been kind of getting hammered. And I want to look at it because I really have a lot of enthusiasm behind Futu. And Futu is a brokerage company. They're like a Robinhood over in China. So we'll take a look at that guy. And then you want to look at GCT. So GCT. All right, let's get into this. Perfect. Okay, so I'll start with GCT, Mike, but first I'm going to hit PAGS. And PAGS is PagSeguro, I believe. And this company, PagSeguro Digital, together with its subsidiaries, engages in the provision of financial and payment solutions for consumers, individual entrepreneurs, micro merchants, and small and medium-sized companies in Brazil and internationally. It provides digital banking solutions, including deposits, top-ups, debt management services, tax collections, wire transfers, ATM withdrawals, and so forth. All right. Over the 1 year, it's down 42%. Over the year to date, it's up 25%. Look at that. We got a winner in 25. So it looks like the stock sold off. It's kind of making a comeback. And if you're up year to date this year, boy, you're doing great. This is a small cap, $2.38 billion in market cap. Revenue is above that, 2.96. And we are seeing this in US dollars. Very good. And very low PE, 6. Man, that's low. Analysts like the stock. It's discounted by 48%, according to analysts. Growth looks good. 17% growth on the top line. This is in the Brazilian currency. And I'm going to look at the conversion in a bit. So the growth looks good. Free cash flow. They had negative cash flow the trailing 12 months, which is really fiscal year 2024. And the year before, they were at 3 billion reals, Brazilian reals. So I'm going to have to convert that. So give me a second on that. And gross margins of 48%. They're more of a fintech financial services company. That's a pretty good gross margin for that industry. All right, so let me take a peek at statistics here on the website. It'll convert some of these figures. So revenue is 3 billion. Okay, gross profit. Got it. Balance sheet. They got $228 million of cash. Debt is 756. So they have 527 net debt dollars out there. Okay. Cash flow. They are negative to 768 million. And I would say that I would look at guidance. I'm not sure why, and I'm going to look at their statement of cash flows in a bit, but debt to EBITDA is nice and low. So why are they cash negative? Let's take a peek at their statement of cash flows. So their net income came in just fine. It actually grew nicely, so that looks good. So they have a negative impact. Here it is right here, accounts receivable. I think we talked about this, Tomas. This is a concerning piece to me, right? Accounts receivable means it's what your customers owe you. And you see that it's for years, they've had a negative impact on that balance. Now, a little bit of that, I would give it, I would say, well, if you're a growing business, that might be growing, but not at these amounts. That's just kind of staggering. If they start to write those balances off, like people don't pay them, then it becomes a problem, a big problem. So that's the line that I would be really focused on. And I would want them to explain that on earnings calls. This is getting too big, too much. Minus 21. And this figure here means that in this year, the accounts receivable went up, meaning customers owed us 21.4 billion reals more. We're lending more money to our customers in the form of accounts receivable. It's risky. It's risky for the company. That's my biggest worry about this company. And I think we've talked about that. So that's an issue. When are they going to do their earnings? May 22nd. It's not around the corner. It's in a month and a half. So that's where we need to hear what they're going to do about that accounts receivable balance. It would be my number one worry. It's a big giant red flag for me. I don't like it at all. And when we look at the statement of cash flow, that is what's eating up all the cash. Because if you had that line and you just had a zero there, it would actually make the operating cash flow turn positive by 18 billion reals. So now we're clearly in the, cash flow, and it would look a lot better. So these guys have to fix this line. What is going on with it? It has to be catching other investors' attention. It has to be being asked. I would bet that if you listen to the earnings call that was recorded for the last quarter, they asked about it. It had to. So that's the number one line that I would encourage you. Figure that out. Why are they accumulating so much darn accounts receivable? And Tomas, I think you have a comment there. What does it mean from the point of view of an analyst that revenue is higher than market cap? Sure. So I think we talked about the cash flow. I made my point there. So when you look at a stock, price to earnings is probably the most referred to metric. It's a metric of you're paying a certain amount for a stock, and that many times is equal to the net profit of that business. In this case here, for the year that we're in, it was 7.3 times the profit that the business made is what you're paying for the stock. That's the ratio. Another ratio that I like to put my head around is price to sales. The market cap compared to the overall sales of the company. If you look at a business like, let's say, Palantir, high growth company, their price to sales, PS ratio, price to sales ratio, is 58. So Palantir is 58. PagSeguro is 0.83, less than 1. So looking at that ratio, PagSeguro is very cheap, very low priced on a price to sales ratio. So an analyst would conclude that if you have a price to sales ratio of 1, that's really low. It's usually industries that are not as preferred by investors and don't carry very expensive valuations. That's where you see really low price to sales ratios. And also international stocks that are riskier. You would see that. And that's what we're seeing here with PagSeguro. So that's how an analyst would look at it. If we look at Palantir, this is an expensive price to sales. You're paying 58 times sales for the company. That's very expensive. Okay, so hopefully that answered your question on that item. So PagSeguro, got to get that accounts receivable item figured out. And when we go to the cash flow, it's negative cash. I think this one here is a sell for me. Too much risk. Negative cash, accounts receivable growing. I don't want to see them writing off accounts receivable because that's like burning cash. That's like, oh, they owe me this money. I don't think that I'm going to be able to collect it. So I'm just going to give up on it. I wouldn't want to see that. I'm not saying it's happening, but that's my biggest worry. They're accumulating that accounts receivable, and I don't like it. So those are my comments. I think that was similar to what I said last time. So I'm sorry if I'm a broken record. All right. So thanks for asking, Tomas. I appreciate it. Let's move on to GCT. And GCT is another small company. They are located in Southern California, I believe, if I'm thinking of the right company. So GigaCloud Technology provides end-to-end B2B e-commerce solutions for large parcel merchandise in the US and internationally. Okay. So they're doing the fulfillment, as UPS, FedEx, they do parcel and they have limitations on the box size. These guys, once you're shipping a bed or a mattress or a furniture, like you're shipping a dining room table, heavy, big, awkward stuff, that's where GCT comes into the picture. It is a small cap, $507 million. This stock has been struggling, down 63% over the last year. Year to date, the struggles continue, down 31%. These small caps are some of them are just getting destroyed in 2025, which opens up an opportunity, frankly, because once we get out of this bear market and things start to go up, the small caps are really going to work. They usually respond the fastest because they're so little, they can really go up in value quickly. Now, we just covered price to sales. This one here, you have basically a 0.5 price to sales. The market cap is lower than the current sales. So that is interesting. Forward P is really low at 5. It's really discounted according to analysts. Interesting. Now, this one I do have a valuation on. So I'll look at the fundamentals and then I'll go to the valuation. Growth is stupendous at 65%. The latest quarter was a little lower, which is a little concerning, especially since it was the fourth quarter, which is, in the US, we have Christmas and Hanukkah and all kinds of holidays where gift giving is big. So, and this one here, its growth started to slow down. Now, do I expect that sales is going to grow? Well, I think a lot of the tariffs are going to hit the product these guys are distributing. I think a good part of the product that they distribute is imported from China and other parts of Asia and then distributed in the US. And I think that product's probably going to get a little more expensive. And the combination of the fact that we are in a slower economy, we might even be in a recession. So people are going to buy less of that product, furniture, kind of these big, more expensive items. They're going to buy less of them. And second is the tariffs are going to just hurt margins for the people that are trying to sell and then use GigaCloud. So I think there's going to be a slowdown there. I would not be surprised if for the current year, I should say, of 2025, GCT sees its sales really crumble, like go negative 10, 20%, because there's a big slowdown in their particular economy. That would not be a surprise. I actually would expect that. I would expect that they're going to have a contraction in their business. They have been operating well. You got to give them credit that, hey, they've been getting it done, making free cash flow. Their cash flow has been growing. So they run a tight ship and they've been delivering cash to the balance sheet. Nicely done. Very nice. So that looks good. Let's take a look at the valuation. And I might do a little tweaks on the valuation because last time I did the valuation, tariffs were not in the story. I did this November. All right. I kind of heard tariffs were coming, but I didn't think they were going to be this bad. So let's take a look. I used a really high discount rate, 15% rate of return. Anybody would be happy with a nice rate of return like that, but these guys are riskier. That's why I'm using a higher rate of return. And I'm using their free cash flows and I'm trimming it down. I think I'm going to trim it down even more because I'm afraid that their revenue is going to be far lower this year. So I would say that this year, I would expect that they're only going to grow their free cash flows by 5% versus 15. And this high discount rate applies. They're small, a little bit risky. And everything else is fine, I think. Let me take a peek at see what their earnings per share numbers are supposed to be. I might need to adjust that a little bit. So the earnings per share this year, it's supposed to be pretty solid at $2.80. PE of 6. I mean, these guys, this is a nicely discounted company. They are making money. They're profitable. And if you want to take the risk on, this could really deliver a nice gain because they're so small. They could double in value and nobody notices because they're such a small cap. They are not going to go out of business, I don't think, because they have plenty of cash. They keep driving more cash. So overall, it's a good stock, but it's risky. Just, be aware of that. For me, it's a buy, but again, it's a risky stock. It's a small cap. I think if you find the right small caps, they just reward you so much. I've bought some small caps as low as like $60 million in small cap. It's total market cap. And that company ended up going up to $400 million in market cap. So from 60 to 400, the company doubled 2 times. And that was wonderful. My money got tripled. And it was like, great. Thank you very much. That's what happens with these small caps. These guys are a small cap. That could happen far faster than a big cap stock that's at $1 trillion. It's going to take a while for that to double, maybe 5 years, maybe 4 years, maybe 6 years. But these small caps, if you buy them at the right time, that are good quality small caps, can really reward you. So those are my opinions on that one, Mike. And I'm going to update the date on that since we updated the numbers. And that will be in the refresh that I'm going to do tonight. And you should be able to see this on the shared directory that members have access to. Thanks for asking about that one, Mike. And good luck to you on with your investments this week. All right, so let me take a peek and make sure that I'm caught up here. All right, I think I'm caught up. And Mike, you also asked about Futu and Paco. How you doing, man? Amen to small caps. All right. All right, cool. Let's take a look at Futu. Now, Futu's a lot. Well, it's not like Robinhood, but it's like Robinhood in one way of me describing the company is Robinhood's really doing great here because they focus on a part of the market, the younger investor, and they're doing great. And they keep getting bigger and stronger. That's great. Futu is servicing the investor predominantly in China, in Hong Kong, and they're doing it great. Their growth is fabulous. And they were getting destroyed earlier today. They were like down 10%. Year to date, the stock is barely down. You could see that it was really going up nicely, and then it's really come down. Over the 1 year, it's still up 40%. 5 year up 632%. Wow. $11 billion market cap, and then revenue is $1.5 billion. So the price of sales on that is going to be about 7 times. So 7 times sales is what you're paying for this business. This is a growth business. That's why it commands a price to sales that is 7 times higher than PagSeguro, not as high as Palantir. But 31% growth is very, very impressive. And look at that growth. It's not a 1-year wonder. It is, we are building a big business in China where people are investing their hard earned money into stocks, equities, bonds, and other investment types. All those things are, from a addressable market perspective, the market in China is humongous. There's a lot of people, and their middle class is really expanding. So I think they're going to do well for a long time because they have plenty of addressable market. And if they keep growing at those rates, that is awesome. They have free cash flow, and their margins are right there with financial services. They're not as good as software, but their gross margins are good. When I do a valuation on Futu, it's a stock that I own Baba in China and then Futu because I've done really well. I've done really well with Robinhood here, and I just do the numbers, and these numbers are ridiculous. These guys are growing so fast. They're profitable that I just think this thing's going to double, triple very quickly on me. It's going to come with a rough ride, especially recently. I think I'm down on the stock, but I keep buying shares because I think these guys have the right story in China. China continues to grow their middle class. There's plenty of people that are going to become investors. So I like investing in Futu. I think it came up in one of Mike's comments, so I wanted to point to this stock. It's been struggling lately, but not the stock price has been hit. But the business, from what I'm seeing, it just continues to flourish. So that's where I'm at with Futu. All right. So we covered, looks like 6 stocks so far. Thanks so much for suggesting those. Just on the live streams, guys, I know that in the past I've covered a lot of different stocks. I'm trying to slow things down a bit. I'm just going to cover member suggestions or requests and any super chats that come out. That way I can slow things down and really go deep on stocks and cover them in full length, not being a big rush. So if you'd like me to analyze the stock, become a member or do a super chat. To become a member, you go to my YouTube homepage and you go here and you're off to, you can get signed up. And when you come on these live streams, your name comes up in different font color. You can request stock tickers for me to review. I'll review them and we're good to go. You also, as a member, get access to the tools I'm using, the analysis model that I use predominantly, and then the analysis I do, I'll publish on a Google Sheet. You can take a look at it. I have other things out there too on the directory of tools for members. So please consider it. If you want me to review stocks, please become a member or buy a super chat if you don't want to be a member, but would like me to review a stock. All right. So you like Futu as well, Mike? Yeah, there's a lot to like there. And I like the story, and man, Robinhood is doing a lot of things right. Everything I hear about Robinhood is they're doing things right. And I think Futu similarly is getting things done on the Chinese side. So it's good to diversify like that. I'm not putting a ton of money into Futu. I'm putting a little bit of capital. And if it works, great. It's a nice win, but I'm not going to expose myself to too much risk on that. All right. So we've covered all the member requests. Looks like I'm all caught up there. Let's take a look at the other earnings that are coming up for the rest of the week, and then we can try to wrap up the show. All right. So today we had Levi Strauss. Good to see them come out and announce. I'm glad to see that they did well. I'm glad to see their stock is rallying. If anything, I'll take any good news that comes our way. We've had some pretty shocking stories over the last week, and we've seen the stock market sell off too much. So it's nice to see Levi's had a positive day. Now we got on Tuesday, We got RPM International. I'm not sure what they do. Let me open that guy up really quick. Then we have Walgreens competes against CVS. That'll be interesting to see. Cal-Maine Foods. That one looks neat. Let's kind of open that guy up. WD-40, they do lubricants, and it's kind of a staple. It's kind of a staple stock. Interesting. Tilray Brands is an apparel company similar to Levi's, not as known, but they're similar to Levi's, and a couple others. So that's coming up on Tuesday. On Wednesday, we have Constellation Brands. Now, that's a pretty good size market cap. That'll be interesting to see. That is a staple stock, so they should be doing well. This one, Delta, this is going to tell us a lot. It's going to tell us about travel and the consumer. Is the consumer spending money? And so far, the reports that have been coming out is consumers are not flying. They're saving their money. They're not flying and spending money on travel. And that's a signal that discretionary spend is really slowing down. So when Delta announces on Wednesday, I think they're going to tell us a little bit of what the economy truly is doing. Other than Delta on that day, the Simply Good Foods Company, never heard of them. They might be kind of a staple stock. We'll take a peek at that one. And then Thursday, we got CarMax. I'm really looking forward to that earnings because, we've seen the tariffs come into the picture, and that might raise especially imported car prices. Well, CarMax is sitting on a pretty big inventory of used cars. And I think used car inventories in a tariff war, it's going to go up in value. So I would say that CarMax is going to tell us about car value, and they're going to probably announce, hey, we're making more money on car sales. I don't know what they're going to say. So I'm looking forward to the earnings and seeing what they have to say there. And then on Friday is a big day. We have JP Morgan, Wells Fargo, Morgan Stanley, BlackRock, Bank of New York. These are big banks, man. Look at the market cap there. Well over $1 trillion of market cap is going to announce on Friday. And that is going to be a big day. If the banks are going to tell us what they think the economy is going to do and what the economy is doing, they're going to guide accordingly. Fastenal is an industrial company. They do fasteners. We'll see what they have to say as well. They may also guide based on the economy and their outlook. And I'm sure they import a good part of their product as well, because they do a lot of fasteners, and they're trying to fit a certain price target or price, in the market, because a lot of their customers are these general contractors. All right. So Cal-Maine Foods. Ooh, egg products. Wow, interesting. And they've had a tough time recently, but they're pretty good for the 1 year. And then the 5 year, look at that. This is a food company. It's farm products, consumer staple, doing really nice. Now I'm sure they're going to figure out, how to get more eggs. I think they had this bird virus that killed a lot of birds, a lot of chickens. And now hopefully they've gotten their flock restored, and they can start producing the amount of eggs that they need. This might be a little bit of an opportunity for the right investor. And that's Cal-Maine Foods. We'll take a look at it when they announce later this week. And I think the other browser's closed on me. So that's what's going on this week. It's going to be a good week to get, started on earnings and kind of change the topic. These tariffs, I'm kind of already tired of them after a short period of time, because they've kind of have affected the stock market so much. All right. So thanks again, everybody, for tuning in. I think I'm going to go ahead and land the plane. Mike, thanks so much for tuning in. And Paco UW, thanks so much. Appreciate you guys. Tomas and Herdo, thanks for joining. Thanks, everybody, for joining. Good luck with your stocks this week. I hope we do better. It's been a rough couple of weeks, man. Ever since February 19th, the stock market's just been getting hit hard. So if we can have a couple good days, boy, that's what the doctor is ordering, because it's been rough since February 19th to now. The Nasdaq's down 22%. It'd be nice to have just a couple up days this week. Boy, that'd be awesome. It's like living somewhere where it doesn't rain, hasn't rained in months, and man, everything's so dry. And as soon as it starts raining for the first time, it's like a miracle. It'd be kind of a small miracle if we can have a couple decent up days this week, because it's been kind of a rough couple weeks, excuse me. So anyway, so with that, everybody have a good night. Thanks for tuning in. I appreciate you, and have a good night.